Good afternoon, this is Brad Dennis with BIS Commodities with your market wrap-up for the first week of September. Start off with livestock. Cattle traded basically in the same range as last week, but ended at the lower end of that range. Most of the demand for the Labor Day weekend we've already seen. People have held back the cattle, so those numbers are increasing. Today we heard a little bit about 142 cash trading, but for the most part, you're looking at good supply right now with lower demand having moved past the holiday weekend. Feeders were on the low end as well. A lot of people looking at where June cattle are. June cattle closed at a 133 average. Very hard to buy over $2 for feeders and hedge up at 133. It just doesn't pencil out right now. In the hogs, just the opposite. Very good exports this week, and it looks like we're at the top of our range. December hogs got up to almost 160 or almost 65 this week. Came back down to about 64 for the close. Have to see a big close over that 65 mark just to get a breakout going to the upside. Otherwise, we're still going to be range trade 64, 65 area down to that 60, 59 area. Over in crude, big week for crude. It bounced off of its sub 40 levels. This was due to OPEC coming out and saying that it would listen to other producers about maybe paring back production numbers. Saudi Arabia is the one that controls OPEC, and they really have kind of dismissed that. It seems like it was just a ploy to get a little bit higher prices, and today we did end a little bit softer. That short covering rally, though, extended those prices up there because we had a lot of people selling into this crude oil market with fears about China's growth aspects over the next year. So it did catch some people short, and that's why we had such a big rally in the crude this week. Stocks saw a similar fate to crude on the other side, in that the fear of China crept into our stock market. Everybody's worried about Chinese growth and what will happen for the rest of the year. And if China does slow down drastically, then world growth will slow down. They're also scared that if world growth slows down and we raise interest rates here in the U.S., that'll be a double whammy for our stock market. Now today we did have jobless numbers come out. Non-farm payrolls were up about 173,000. They missed the mark of 220. Unemployment rate fell down to 5.1% though, and my hourly earnings went from an estimated 0.2 up 0.32. So higher wages, and that's what everybody looks at, is wage inflation. Lower unemployment rate, even the overall, what I want to say, unemployment rate was closer to 10.8. The real unemployment rate was close to 10%. And if you look at the revisions for June and July, and you look at it as a 3-month period, we're still averaging over 220,000 jobs created a month, which is pretty good numbers. So I think you do have a better possibility of seeing a rate hike. Will that destroy the U.S. market? No, you're just talking about 25 basis points. But with GDP being revised up to 3.7 and with these job numbers, I think it doesn't take away any reason or say you can't hike rates. It says, hey, numbers are still strong, they're growing, so if you want to do it, go right ahead. And I think that that's what the Fed is looking at. In the grain markets, it looks like right now we're back testing those August lows in corn and beans. The lows that we saw after the S&D report last week now, or last month. We're going to have another S&D report. It's going to be out on Friday of next week. People feel that those yields will be lowered somewhat, and there could be a little bit of short covering rally going into that. For right now, though, Everybody is focusing more on the demand scenario than the supply scenario. Once Informa came out with like yields for corn and for beans, everybody took a step back and said, all right, well, if we do have that, where's demand going? And they recognized that the demand for beans is about half of what it was last year. If you look at where we're at this year, you could almost pare back your exports to about a 1.5. And with beans, exports are 50% of the demand side of the balance sheet. So that's a huge loss to about 225 million bushels. So you put that and you put that into the carryout stocks, and all of a sudden you're back up talking to 500 million. Now, that's an extreme example, but when you look at the demand is nowhere near where it needs to be for the projections that we have out there right now. And maybe this is due to China slowing down over the past couple weeks and their economy starting to stumble a little bit. We'll know those numbers better next Friday, and that's what the trade is going to gear up for. Now, we do have a 3-day weekend, so trading will not start until 7 o'clock on Monday night. So no Sunday night trade for us. So that is your update for the week, and end of broadcast.